Right now, the thing Wall Street feared most just happened. On December 26th, 2025, silver didn't edge higher. It detonated. It tagged $79, $11 an ounce. And the part nobody wants to say out loud? At that level, silver is being valued around $4, 48 trillion, roughly the third largest asset on Earth, bigger than Apple's market cap, bigger than the names people treat like religion. They told you silver was a hobby, a relic, a boomer metal. That story just died. Because this isn't a cute rally, this is a repricing event. This is the market finally admitting the supply is real, the demand is structural, and the paper game is running out of runway. Welcome back. This is your host, and you're watching this channel. No fluff, no bedtime stories, just the mechanics behind what just broke. Here's what happened in plain language. In January, silver was near $29. Now it's near $79. That's about a 169% surge year to date. Moves like that don't come from collectors buying a few tubes of coins. Moves like that come from stress, from forced buying. From a market that can't find sellers because the physical foundation under the paper tower is cracking. And yes, the psychological punch matters. A metal most investors ignored is now valued above the company that makes the iPhone. That's not silver got strong. That's capital is rotating out of promises and into atoms. So why now? Why this month? Why this speed? Because for 5 straight years, silver has been running a deficit. Demand has exceeded supply every year since 2021. Add it up, and you're staring at a cumulative shortfall around 820 million ounces. Basically, an entire year of global mine output pulled out of above-ground stockpiles just to keep the machine running. Stockpiles are the emergency oxygen tank. When the tank runs low, everyone starts hearing the hiss. You can see it in the vault numbers. A few years ago, one major U.S. exchange reported registered inventory in the hundreds of millions of ounces. Recent figures show that number dramatically lower. London's vault totals have also been trending down, thousands of tons gone over a relatively short window. This is why the price didn't politely climb. It jumped. Because at some point, the market stops negotiating. It panics. Now let's talk about the smoking gun that tells you this isn't just a chart pattern. Lease rates. Silver lease rates are the cost to borrow physical silver. In a normal market, they're boring. Fractions of a percent. The kind of number you ignore because nothing is happening. Then late 2025 hit, and the London market reacted like it saw a ghost. Reports circulated about a giant physical order. Figures as big as 1,000 metric tons, about 32 million ounces. Whether the exact number was 31 or 33 million isn't the point. The reaction is the point. Lease rates went from sleepy to insane, with chatter and prints referencing triple-digit annualized levels. When the cost to borrow metal explodes, it means one thing. Lenders are terrified they won't get the metal back. That's not investor enthusiasm. That's survival pricing. And once that happens, the paper market gets exposed. Paper silver only works as long as the crowd believes the paper can be converted into metal whenever they want. The moment too many people ask for delivery, you find out what the system really is. A claims market, a confidence market, a theater. For decades, silver trading has been dominated by leverage. Futures, swaps, unallocated accounts, ETFs, and derivatives stacked on top of a much smaller pool of deliverable metal. The same ounce gets promised to multiple parties because most of the time, nobody shows up at the vault door. But what happens when they do? You start seeing spreads break. Normally, silver in London and silver in New York don't drift far apart. Arbitrage keeps them aligned. If one market is cheaper, traders buy there and sell where it's higher, closing the gap. Late 2025 didn't behave like that. A persistent premium showed up and refused to close. That's the tell. It means the arbitrage mechanism is choking. It means traders can't source enough physical in one place fast enough to satisfy demand in the other. Translation, the paper price is no longer the real price of metal in hand. So if you're wondering how silver can print $79 on a screen and still feel scarce in the real world, this is why. The market is split into 2 realities, the paper casino and the physical warehouse. When those 2 prices diverge, you're watching credibility evaporate in real time. Now, here's where Wall Street starts sweating through the suit. Because short positions exist, huge ones. And silver is one of those markets where people got comfortable leaning on it year after year because it never goes, until it does. The short is simple. Borrow, sell, buy back cheaper later. Works great until the price rises and you have to buy back higher. Then the losses don't have a ceiling. In a calm market, shorts can manage. In a market where physical availability is tightening and price is sprinting, shorts become fuel. Every tick higher forces more collateral. Every spike triggers margin calls. Every margin call forces buying. Every forced buy pushes price higher. That's a feedback loop, a squeeze. And here's the part the public misses. When one of the big players stops being the reliable seller, everything changes. There's been growing talk that major institutions have been reducing short exposure and quietly increasing physical holdings. Believe every detail or not, the direction matters. The always there seller isn't guaranteed anymore, and the market has to reprice around that new reality. Now imagine being short at $35, $45, $55, and watching the tape print $79 while borrowing costs spike and physical premiums widen. You can't calmly wait it out. You start scrambling for exits, but exits are narrow when everyone is rushing at the same time. This is why the price action feels violent. It's not just optimism, it's forced repositioning. Picture the chain reaction. A fund is short through futures. Silver jumps, their broker marks losses. The broker demands more collateral. If they can't post it fast enough, the broker liquidates, meaning it buys back the short into a rising market. That forced buy spikes the tape, which triggers the next margin call, which triggers the next forced buy. This is why squeezes feel like gravity reversing. And it's not isolated. The same institutions that trade silver also trade everything else: rates, FX, credit. If they're bleeding on a silver short, they sell what they can to raise cash. They dump liquid assets, they tighten risk. Liquidity dries up. That's how a metal move starts leaking into the system. Now let's expose the paper stack, because this is where people get fooled. Most market participants don't touch bars. They touch representations, ETF shares, pooled accounts, futures that are almost always rolled or cash settled. Those instruments can trade in huge size because they're not constrained by pallets and forklifts. They're constrained by confidence. When confidence holds, the system feels liquid. When confidence cracks, everyone suddenly asks the same question: can I actually get the metal? That's when you discover the uncomfortable truth. Many silver products are designed for price exposure, not delivery. They're tracking tools, not warehouses. So when physical is tight, paper can trade cheaper than real metal because paper is plentiful while metal is not. It sounds backwards until you realize what's being priced is delivery risk. That's why premiums are the canary. A 1-ounce coin selling $20 above spot isn't just markup. It's the market charging you for immediacy and certainty, metal in hand, not a promise. And here are the next triggers people are underestimating. First, the first full trading week of January. New Year allocations don't arrive gently. They arrive in chunks. Funds buy because their models say add. Managers buy because underperforming is career risk. That money lands in a market already short of sellers. Second, the Asia Open after holiday thinness. If physical premiums stay elevated outside the Western paper venues, arbitrage traders smell blood. They buy where it's cheap and chase metal where it's scarce, and that process forces the paper price to chase the physical reality, often with gaps, not gentle candles. So if you're expecting a neat, polite consolidation, understand the risk. The next leg can start with a jump. And then there's the geopolitical accelerant that makes this story bigger than finance: China. A big chunk of the silver supply chain runs through refining, and China is a major hub. Metal mined in one region often travels across oceans before it becomes the high-purity product industry needs. Starting January 1st, 2026, new export controls are set to tighten the flow. Licenses, consolidation, more friction. You don't need to be a conspiracy theorist to see the impact. If the world is already running a deficit and the pipe gets tighter, buyers outside that system face a harder problem: compete for a smaller pool of available metal. That's not just a price story, that's a supply chain story. And supply chain stories don't end with, and then it went back to normal. They end with premiums, stockpiling, and strategic behavior. Because silver isn't just jewelry. Silver is a technology metal, a strategic metal. It is the most conductive metal on Earth, and it lives inside the hardware that powers the modern world. Solar panels need silver paste to move electrons efficiently. EVs use silver across power electronics, sensors, and high reliability connections. AI data centers are electrical monsters. Power distribution, cooling systems, and components where conductivity and reliability matter. And defense systems? The high-end stuff isn't built with good enough. It's built with what works. Here's the key. A lot of this demand is inelastic. If you're building solar at scale, you don't cancel the project because silver is expensive. You adjust budgets, you lock supply, you pay, you keep the line moving. You cannot cheat the electron. Physics always wins. Now, you might be thinking, fine, if price is high, won't supply surge? That's the trap. Silver supply doesn't behave like oil or wheat. Most silver is produced as a byproduct. It comes out of mines primarily chasing copper, lead, zinc, and gold. So higher silver prices don't instantly create a flood of new silver. The incentive structure is sideways. And even when a primary silver project is viable, it's slow. Permits, studies, financing, construction. The market can reprice in weeks. Supply responds in geologic time. So while demand can spike quickly because factories scale and governments mandate transitions, supply can't just snap to attention. This is how deficits become structural. This is why vaults get drained. This is why $79 isn't automatically the top. It's a symptom. Now let's get to the street level where the truth leaks out first. Go try to buy physical. When markets are calm, dealers are stocked, prices are transparent, spreads are reasonable. When markets are stressed, you start seeing the same words pop up like warning labels. Out of stock, delayed shipping, call for price. That last one is brutal because it means the seller doesn't trust the screen price. They don't know what replacement cost will be tomorrow. And premiums explode. The official spot price might say $79, but the walkout with metal price can push far higher depending on product, location, and availability. That gap between paper and physical is the heartbeat of the shortage. It's the market telling you the quoted price is for paper. The real price is for atoms. So here's the question for you. If the screen says one number and the real world charges another, which one is the real market? Drop your answer in the comments. And if you want updates as this develops into January, hit subscribe. Short, simple, and done. Now, the calendar is a catalyst. We're in late December, holiday liquidity, thin desks, fewer sellers. That is the most dangerous environment for anyone trapped on the wrong side of leverage, because in thin markets, prices don't glide, they gap. A small order can move the tape, a big order can rip it. And if you're short, weekends are torture. You can't fix it while the market is closed. You just sit there and feel the risk of a Sunday night gap growing in your head. This is why squeezes accelerate around holiday weeks. Not because anyone wanted it, because liquidity disappears and stress concentrates. Now add the January effect. Institutions rebalance, new budgets, new allocations. Funds that missed the move look at performance tables and realize they're behind. And when they're behind, they don't buy dips. They chase momentum because underperforming is career risk. So as we roll into early January 2026, you're looking at a market with a multi-year deficit, shrinking visible inventories, physical tightness via premiums and borrowing costs, geopolitical tightening in the refining export pipeline, and a fresh wave of institutional money that arrives because we have to own it. That combination is how you get vertical moves. Will it be smooth? No. There will be pullbacks, sharp ones. Traders who bought early will lock gains. Algorithms will hunt stops. Headlines will try to scare you out of your seat. But ask yourself the only question that matters. Does a $5 pullback refill the vaults? Does it erase the deficit? Does it remove silver from solar panels, EVs, and data centers? No, those are structural forces. Volatility is just the market digesting them. And that brings us to the part the mainstream still refuses to say. This is a trust crisis disguised as a commodity move. The world is swimming in debt. Deficits don't end. Currencies get expanded to patch holes. And when enough people decide the measuring stick is shrinking, they do the same thing. They rotate into scarce physical things. Gold does it quietly. Silver does it violently. Silver is the high beta lie detector. Now, about targets. Everyone wants a number. Everyone wants a screenshot. Everyone wants certainty. Here's the honest framework. In precious metal bull markets, the gold to silver ratio often compresses. If gold stays high and the ratio drops, silver can move faster than people expect. That's not a prophecy. That's math and history colliding with a small market. But here's the real risk to watch, the one that turns this from bull market to event. Counterparty stress. When markets get this hot, rumors multiply. Screenshots fly around. Every trader suddenly has a contact in London. You don't need a rumor to be true to understand the danger. If even the possibility of a settlement problem enters the conversation, risk managers tighten limits. Funds reduce exposure. Banks demand more collateral. Behavior changes. And behavior moves price. This is why understanding what you actually own matters. Some products are metal. Some products are promises. A promise can be rewritten in a crisis. A bar cannot. I'm not telling you what to do. This is not financial advice. I'm telling you what to understand. Allocated versus unallocated matters. Redemption terms matter, because the difference between a claim and a bar becomes very real when a market breaks. Now zoom out one last time to the political layer. If silver keeps sprinting, it doesn't just hurt speculators, it hits manufacturing costs. Solar gets more expensive. Grid upgrades get more expensive. Defense procurement gets more expensive. Suddenly, a metal most politicians never mention becomes a topic in closed-door meetings. And when politicians get involved, it gets messy. Blame, investigations, talk of hoarding, talk of volatility, maybe even emergency language about critical materials. Ironically, that kind of attention doesn't calm the market. It validates the shortage. It tells every serious buyer, secure supply before rules change. That's how hoarding goes institutional, quietly, professionally, aggressively. So where does this leave us right now? At the edge of a new phase, from disbelief to acceptance. In disbelief, people laugh. In acceptance, they buy, and in panic, they pay whatever it takes. We're moving through that sequence, and you can feel it. People aren't asking, should I own silver anymore? They're asking, can I still get it? And that is the difference between a trade and a crisis. I'll leave you with this. For decades, silver was treated like a side character, something you could suppress with paper, scare with volatility, and ignore in portfolio meetings. Now it's sitting at the center of technology, energy policy, and monetary distrust. The old system relied on one assumption: nobody would demand the metal all at once. That assumption is being tested. And tests don't end with arguments, they end with outcomes. So tell me in the comments, what do you think hits first in 2026? $100 silver, or a public admission that the paper market can't deliver at scale? And if you want the next update as soon as it drops, subscribe. Because when the world discovers the vaults don't have what the contracts promise, this moves from market story to history lesson overnight.